Do you think that's what's going on with the market today? Hearing what Paul Tudor Jones said, deciding maybe rate hikes aren't in the cards for next year? Is that why we've rallied this afternoon somewhat?
Well, I think maybe after what we saw in terms of what the bond market did last week, we're only a week or 4 or 5 days away from this changing again. And the market, it's been incredibly humbling to be bullish, really has. And so the true test of a person is how they handle adversity, not success. Anybody can be happy when the markets are going up, and momentum goes in both directions. And unfortunately, we're dealing with a market, Kelly, that has really nothing to do with fundamentals and has everything to do with news flow and data.
But it's always like that.
No, it isn't.
In the
It's not
sense
always
that
like
news
that.
flow always pushes it around.
But I will say that for the last 12 months, we have been a bullet point society in terms of investing, and it's excessively unfortunate, really have. And so it's humbling being bullish. And so sometimes the screens are green and sometimes they're red, and there's a lot of red to deal with. So when there's a lot of red to deal with, you default to fundamentals, okay? Now, the economy still looks good. Earnings still look good. Risk assets, I despise that comment. Equities, we believe, are the place to be, and U.S. equities in particular. So guess what? U.S. equities are on sale. So the more fundamental that you are, the more that you believe that the stock market is a market of stocks, and stop looking at ETFs only to outperform. Like the banks today are giving you a generational opportunity. Banks are not going away in U.S. financials, especially the big ones. And so we believe that this day will too pass. And again, we're 5 days away of good market performance, and we're going to talk about rate hikes again next year. So that's all that is.
Isn't there some fundamental basis for what the market's doing here, Chad?
Yeah.
In other words, the market looks forward, and maybe what it's seeing in its forward look is slowing profit growth and a slowing economy that would mean it doesn't deserve the price that it had been commanding earlier.
Right. So I agree with Brian that the United States is the best place to be, and you should be overweight U.S. I think, though, what people may be getting wrong is that the global growth backdrop, China, for example, as well as the Eurozone, is decelerating. And when you look at it from a purchasing power parity, GDP, China is roughly about 20% larger than the United States. So as demand shifts lower there or decelerates, because credit growth decelerates, that has a meaningful impact on trade, on actual European growth and trade.
Do you not think that the U.S. economy is decelerating?
I think that overall the U.S. economy is moderately decelerating. We have a glide path of roughly 2.5% over the long run. That's way more optimistic than the Federal Reserve at 1.75%.
Which brings us to those rate hikes. So if that's your point of view, you think we got a couple more still coming?
Well, I think that you get one in December, and I think they're conditional based off of financial conditions. And we've been saying that all along, that financial conditions will sway the Fed to stop.
So you think
and we think they're going to pause. They potentially will continue to reduce their balance sheet moderately, but they'll wait and see how the overall global system takes a reaction.
So one more and then a question mark as far as your
one more question mark.
And what do you think,
2 points.
Brian?
First of all, moving from 3.5% GDP to 1.75% is not a recession, ladies and gentlemen.
Right.
The market's acting like it's a recession. No recession, number one. Number two, to push back on Tyler a little bit, because he's my pal, the market's discounting mechanism has been broken for about 24 to 36 months. We react so much to what's happening today. We're not looking forward. We're so worried about keeping our seat if we're an equity investor.
But we are looking forward. Everyone's sending around charts of jobless claims showing the 4-week moving average and saying, look, it's ticking up, and it's that point.
Because we become so macro-oriented, we forgot how to pick stocks. We
But
forgot to look at companies.
Looking, and of course you're right about looking at companies, but we're all still looking at whether the macro is slowing down. Isn't that a legitimate concern?
Yeah, but you just walked yourself into a trap, Kelly. Because macro investing is looking backward at what already happened.
No, it's not.
Yes, it is.
No, it's
global
not.
growth and global credit's decelerating or slowing down. That's going to have a meaningful impact on inflation expectations as well as on valuation. So we're in a low return environment across all asset classes.
My only point is this. If we're talking about the Federal Reserve not hiking because the economy's fine and there's no inflation, that sounds fantastic. It's only if there's concern that we're slowing that everyone has to get all concerned.
I think Chad is spot on. But the issue is that investors are still so focused on global synchronized growth that everything needs to go around China. This is about America, and growth is going to come from America, not from emerging markets. And we're still so stuck on this global
Do you care about what the Wall Street Journal pointed out this morning, which is the idea that people are not coming in to buy the dips, the declines? Do you care about that? Or is it a non-event for you?
Well, we're investors.
And that the only other times that has happened, we've either been in the middle of or at the start of a bear market.
Well, I remember back post the tech wreck, and during the tech wreck, if you remember, in 2000 into 2001, it was buy the dip, buy the dip, buy the dip, until it wasn't buy the dip anymore, until Cisco came out second quarter earnings of July 2002 and said, I don't know what's going on with our growth. That was the bottom. We need to see these types of events saying, we need to see a fundamental leader going, I don't know what's happening here. This has nothing to do with fundamentals, and that'll be the bottom. And I think we're closer to that today than we were last week.
Just in a low return environment, you want to move up the quality spectrum. You want to be in high quality, rising dividend type of companies here in the United States. You want to shy away from the EM. Political risk, business political risk, now is starting to dampen the market multiple.
Finally, on that point, Brian said he thinks this is a generational buying opportunity in the banks. We mentioned that Goldman Sachs is at a 2-year low, giving back all of the gains after Trump was elected. Do you agree with him on the banks?
I believe that you have to follow the yield curve. I'm not so bold to go out and say it's a generational buying opportunity.
Be bold.
If the yield curve steepens, then you follow the data points and then you start to overweight it.